This video on the best landlord tax deductions is brought to you by AmerUSA, where you can screen tenants 24 hours a day. Whether you do it yourself or hire a professional to help, maintenance and repairs are fully permissible tax deductions taken for the year in which they occurred. An example would be fixing leaks, clearing drains, patching walls and painting, servicing HVAC systems, replacing cracked tiles, exterminating pests, and cleaning carpets. Landlords may deduct a portion of their real estate acquisition costs through depreciation. The IRS allows the cost of a building to be depreciated over 27.5 years, but not the cost of the land since it doesn't depreciate. Here's an example. If you purchase a property for $120,000, the land is valued at $20,000, then the property basis is $100,000, which you divide by 27.5 years, and you'll receive a $3,636.36 annual deduction. Landlords are also allowed to depreciate the cost of additions and improvements to each rental property over a period of 5 years up to 27.5 years, depending on the item or service purchased. An example would include appliances, air conditioner, carpeting, furniture, fencing, landscaping, and a new roof. Interest payments are one of the largest tax deductions and include not only mortgage interest used to purchase or improve rental property, but also credit card interest on related products and services for the rental property. Whenever a landlord drives for a rental property to see tenants, meet contractors, or perform maintenance, the use of the vehicle may be deducted using one of the following two options. The first option is to deduct the total mileage driven for the year using the IRS mileage rate, currently 58 cents per mile. The second option is to deduct expenses like gas, oil, and repairs. Landlords may deduct the premiums paid for most insurance policies for the rental property and the business of managing it, even the business use of an automobile. This includes accident, casualty, theft, flood, fire, and liability coverage. The portion of a landlord's personal residence that is used for managing a rental property is deductible. This may be a dedicated area or room used for screening tenants, paying bills, and other management tasks. There are two types of expenses that may be deducted. The first are direct expenses. These are specific purchases for the home office area. These may be fully deducted or depreciated depending on what was purchased. The second type are indirect expenses, which are general housing bills like mortgage interest, taxes, utilities, and insurance. These are fully deductible based upon the area of the home office. To calculate the deduction for indirect expenses, you would divide the area used for the home office by the total area of the home. In this example, if you have a 400 square foot home office in a 2,000 square foot home, you would be allowed to deduct 20% of the total amount of indirect expenses. For additional laws and articles, visit AmericanLandlord.com.